Welcome to Season 2 of Grain IQ. I'm your host, Chad Moyer. Grain marketing is a critical piece in keeping your operation profitable, and in Season 1 of Grain IQ, we covered the basics of grain marketing. Season 2 dives deeper into the grain marketing concepts, like technical versus fundamental trading, puts and calls, and exploring how reports do or don't matter in your grain marketing plan. If you haven't listened to Season 1, I'd invite you to start there. Now today we're exploring the players in the futures market, who is involved, and how does that impact you, the farmer. Justin Lovegrove joins us for today's conversation. Justin is owner, president, and grain marketing advisor with the ARC Group. First of all, before we kind of get going on today's podcast, I'd just like a little bit of background information on you and how you've come to kind of have a passion about what happens within the futures business, and then also how that's developed into working with farmers, Justin.
I'm an open book about how I started this business and the reasons we did it and the reasons we're still doing it today. And I'm kind of proud to be from a large farm operation just south of York, Nebraska, and based in, I claim, Grafton, Nebraska as home. And I learned a lot growing up, how they operate the farm. I had experience of doing some CPA work or some accounting work for a firm in York, Nebraska in the winters after harvest. I was actually farming at the time and got to interview farmers about how they manage risk and how they make futures decisions and everything. And I found out that everybody kind of gave me blank stares back and had, for the most part, no idea how they did on their farm marketing last year versus what kind of benchmark, and they really didn't know, and I was kind of blown away by that. Talked to a buddy of mine. We talked about starting a fee-based firm to consult with farmers, ranchers, teach them how big commercial grain companies look at grain marketing different than most farmers do. Let's go bunch of 23, 4-year-old kids. Might as well go compete with all the commercial grain elevators out there and go educate farmers on how we think they should look at risk and how ADM, Cargill, all the major commercial grain players educate their salespeople on how they manage risk. Made a decision real quick just to work with farmers, ranchers. We don't work with any commercial companies. I'll mention the word conflict of interest a lot today, typically, and independence, and it's two huge things in our industry that I'm really proud of that we represent. We don't have a commercial elevator backing us, making us trade for them. We represent the farmers.
And it kind of comes back to what you said at the beginning there, the importance of having a marketing plan, because that's what we're trying to do here. We're trying to educate producers and listeners about how the futures market works and how do you get grain priced and manage your risk. And as you've done this for almost 20 years, if you had to define it, if you had to call it something, how do you describe the importance of risk management for today's agriculture, for today's farm?
Well, I think it's important since day one. It's important. I just think that it's being highlighted more as operating notes from bankers get more competitive. They want to see people have some sort of a plan, because it used to take 1,000-acre farmer a couple $100,000 a year to operate. Now it's millions, and everybody's trying to limit exposure. And when we started this, corn was at $2.20, and man, sometimes it'd pop up to $2.30, and then, we'd be at a 40 cent range throughout the entire year. And there'd be a day that corn was up 3 or 4, and we would be calling every client we have and saying, man, you need to sell today. This is the biggest move we've seen in 3 weeks. And, now 3 or 4 on your afternoon reports, we say, gosh, nothing happened today. It's just a complete change in volatility. Money, hedge fund outside money entering the commodity markets is just a lot bigger than it was 20 years ago. So swings are more dramatic, which is advantageous for everybody, I think, volatility, as long as you're unemotional about it and focus on your business, not everybody else's, or not what the neighbors are saying, or don't get stuck looking at the window out your kitchen to see what your crop looks like out your back door. You're just a small part of this, and we just want everybody to mind their own business and manage the risk that they have.
Well, and I think this is a good place to start too, because we brought you on to kind of talk about, okay, who is active in the market, who uses futures, because it is more than just farmers and it is more than end users and grain buyers. And it's important to understand that. So if you can kind of talk about who's all a part of the futures market today.
There is an amazing amount of liquidity in the markets right now. And it comes from absolutely everybody. And I just think that the liquidity and the volume that's out there is good for almost everybody. It creates a ton of liquidity for us to get filled on stuff. It creates volatility. But there is commercial hedge money, when ADM and Cargill and ethanol plants in the state of Nebraska or feed yards or whoever get grain bought, they have a hedge account. They hedge that risk off the second they do it. If they're an ethanol plant, they're hedging ethanol and buying corn. And as they're buying corn, they're lifting their hedges. And as they're selling ethanol, they're lifting their hedges. And there's always that kind of liquidity trading every day. There's always people buying corn and buying feeders, putting spreads on that matters to whether they're crushing soybeans or making ethanol or feeding hogs, like whatever risks they have. You have a lot of these big commercial companies that they want to lock in margin, they want to lock in spread. They're using futures markets to do it because that's what their price is based on, futures. There's a million different kinds of people taking advantage of the futures markets. There's index funds they're a mutual fund that they manage they might be a hedge fund that they can trade wherever they want, and they're 80% invested in stocks, and they're 20% in bonds, and they're 10% in commodities. And by commodities, it's a broad basket all across the board. They might own crude oil and a basket of stuff, and it might be a mutual fund or a hedge fund that only owns commodities. But all of them are trading in the market every day, creating liquidity, creating a market. Some of this stuff is illiquid. You look at Minneapolis wheat and some of the kind of the slower canola markets and things, and you see fund money come in and speculative money come in, and it creates a lot of opportunity for people like us that have exposure to those markets, because there actually is a market for that now. And gosh, 10 years ago, 15 years ago, that market might not trade for a couple of days. And it was just really illiquid, and it was tough to get fills. We actually like this volume that's in the market, but it's farmers and hedgers and speculators and money managers and Joe Schmo down the street that thinks crude oil's going to 200. He's got a spec account, he's buying it. Early on in my career, I was down at the Kansas City Board of Trade when there were actually humans in the pits, and I was at ADM's pit down there, and it was right before they opened, and he's like, I got 15 orders to buy it higher and 15 orders to sell it lower. It takes both sides, and people are biased both ways, and there's short-term money and long-term money. I've got a guy that works for me that manages part of our over-the-counter position, and he came from a high-frequency world. And, we work with, over 1,000 producers, and he was trading more volume in the, opening 30 seconds of a lot of markets than we trade annually. Like there's size out there that they try to make fractions of pennies, but they do it a million times and try to etch out a profit every day. And that's what they do. That's their entire reason of their fund. And, we look at short term as a couple months holding on to a position. They look at short term as a couple seconds. They look at long term as 5, 8, 10 minutes. And we look at long term as trying to sell D's 24 corn, There's a lot of different strategies out there.
Let's come back to a term that you said, or a phrase that you said, the value of volatility, because you said that there's more and more people that are active in the futures markets these days. What is the value of that volatility to a farmer, Justin?
I think volatility works both ways. I think the futures market, if you read all the noise that comes out every day, I call them excuses. Like I don't have an excuse for why corn is down 5 yesterday and it's up 11 right now, and it could be up 20 on the close, or it could be down 8. I couldn't tell you why, but a lot of people are paid a lot of money and try to create clients by going out and saying, this is why corn is up 11 today. And I think that some people mind their own business pretty well and say, well, I've got a great crop out in the field. I've got X% sold. Corn's at 660 today or whatever decent corn's at. What kind of profit can I make there? I think people need to get back to looking at their profits and figuring out what kind of money they can make. They've got to look at their farm as a business, not a hobby, because if they're not going to, other people are looking at it as a business, and they're going to get ran over long term if they just look at it as a hobby. It's a business. If you're going to show up to something every day and put food on the table for your family, and we think that one of the best ways to recruit the next generation is to have a super profitable farm. We don't think the next generation of farmers wants to come back and drag their feet and not make money. I mean, they might like the lifestyle for a while. They might like the hunting. They might like working cattle, but boy, money's a pretty big incentive to get the next generation back. And I think volatility is either going to make people put their head in the sand and do absolutely nothing and say, this is crazy, I can't understand this, or they take advantage of volatility. And maybe if corn in the last month has had almost a dollar rally from the bottom, and you can get bowled up and say, gosh, this thing is going to go up forever, or you can say, geez, it's been a heck of a rally, and I've got this crop in the field, and this is my production, and this is what my expenses are looking like now. I know a lot more about my irrigation costs and fertilizer costs than I did 9 months ago. Need to make decisions based on this move, and volatility is good for the producer long term, I think. Cattle guys, people that need to buy grain in cheaper than it probably should be once in a while, and it lets people sell grain higher than it should be once in a while too.
It's safe to say that volatility creates opportunities, but you have to have a plan in order to take advantage of that opportunity, right, Justin?
You have to have a plan, and I've done a lot of work on this in my career, and we actually did this before we started this company 19 years ago, and we found out that we did a lot of research based on what we call market guessers, guys that are paid to try to outguess the markets. And what we found is there's an absolute ton of research in the stock market, the S&P 500, Dow, smaller stock stuff, Russell 2000. There's a ton of information on returns long-term on that. So if you're a money manager and you're comparing yourself against an S&P 500 index and you're over a 10-year period, you're getting beat by 2% every year, you're probably not going to have a job because you're underperforming your benchmark and you're still charging your clients fees and everything. What we found real quick from a study from the University of Illinois was they looked at 50 market advisors compared to benchmarks over a 10-year period. And benchmarks are kind of tough in commodities because what's a benchmark in corn? Our joke is it what your neighbor says he sold his corn for? That's the benchmark. So he's always going to be the best, I think. What they did was compare it to a seasonal average. They did a February through June average pre-harvest and just blindly sold. It's about 1% a day. It's about 100 trading days in that time frame. And they just sold that average for 10 years, and then they rolled carry. They said they put it in the bin, and they rolled carry over the average of, I think it was October, and sold cash post-harvest. Well, what they found was that benchmark, ignoring all the noise, doing a regimented program every day that just sold futures pre-harvest, beat all but one of those 50 advisors. We decided pretty quick that there's no way that we can try to be that one guy to try to outguess these markets, and it creates a ton of emotion. And honestly, for a book of business like ours, it creates a lot of volatility in our book because we're going to be right one year and we're going to be super wrong one year, and you're going to have to go rebuild your book. And we'd rather work on what we can actually control in the futures markets or the grain markets, which is having futures decision, trading cash grain, looking at basis, looking at carry, things where we can actually value add. We're just looking to get a futures position on because you can't go past that and trade basis and carry if you don't have a futures position on.
And there's another comment that you said before too. Some farmers bury their head in the sand because they don't understand it. They think it's confusing or too much information. They get overload, whatever the case may be. Should that prevent you from being active in the futures market? I mean, are there people that you should have around you that can help you make sense of it, or at least come up with a plan, Justin?
I absolutely think so. And I said before, if you put your head in the sand and do absolutely nothing, that's making a decision in the futures market. You're making a decision to do nothing, and that's an absolute business decision every day. I'm involved in a bank in Omaha. I'm on the board of a bank, and I can tell you, nobody in the world knows where interest rates are going. They can guess, and boy, the economists are about as worse predicting interest rates as most farmers are predicting where corn's going. I can tell you, we can't say, we have no idea what's going on with interest rates. It doesn't make sense. We're just going to do nothing and put our head in the sand. we're going to change our business, do what we can, expose our, hedge our risks off, whatever we can do every day to try to edge out a profit. And that's long-term how you're going to stay in business. But I think you need people that are independent, helping you. I'm a big believer then you should hire an accountant to do your taxes. You should hire, if you're not a Wall Street educated stockbroker, you should probably either buy index funds or have someone that manages money for a living. There's specialties out there. I trust the oven downtown to cook a little better Indian food than me, and you hire out things that are they specialize in things. And I think an independent source in the commodity markets, independent being one of the main tenets of our business, is we don't represent commercial grain companies. Captive supply is what we try to keep away from our clients. And I use the comparison back home on my farm. We've got about 6 end users, ethanol plants, shuttle loaders, food grade facilities, co-ops. We've got all sorts of stuff within 15 miles of our Bend site. And if I listened to the one merchandiser of the one ethanol plant, and his advice was to forward contract grain, forward contract grain, forward contract grain, to them, I can guarantee you our farm wouldn't be where it is today. Farmers want to be an independent group of people. And I think if they do the right things, they can be independent, but being reliant on one end user, cash forward contracting grain, giving away captive supply of that grain, it kills them over the long run. You want independence. So we separate out futures basis and carry and make 3 separate decisions, just like commercial grain companies do when they buy your grain.
So if a producer decides that they do want to be active, they want to have a futures position, they want to use futures as part of their risk management plan, how do they go about accomplishing that?
One of the first things we explain to our clients when we're getting to know them is, you've got to be comfortable with futures before you get into this market. You got to know what you're talking about. And one of the biggest things we compare to is you can do a seasonal average trade through almost any co-op, any ethanol plant, any shuttle loader out there. And it's a great way to price grain, we think. But on my farm, if I'm going to do a seasonal average on futures, I'm not going to guarantee it to an end user. I think there's a better way to do it. I want to do it for my own account. Therefore, I'm independent from everybody. So the first thing we do is we educate farmers on, how does a hedge work? The number one thing we do in our office is educate these farmers on, why do we want to use futures? You're already using futures, using the co-op. You just don't know it. You're doing it for their account. We try to get these guys to think independently so they're not reliant on end users' money. They're self-reliant. We talk them through how a hedge works. If corn's at $6.50 today and corn goes to $5.50 at harvest and they need to be a seller at harvest, we're going to pick the best basis level we have at harvest and we're going to lift our hedge at the exact moment we make that cash sale. And that's how futures work. You're going to have a gain in your account and you're going to have $5.50 cash sold if it's zero basis, and the exact same thing the other way. If corn's at $7.50, you're still going to get $6.50 corn. You're just going to have $1 loss in your futures account, and you're going to sell $7.50 corn, and it's going to net the same. The only reason we do that is everybody looks at a hedge as a short position, and it is in your hedge account. But for our producers, it's a neutral position because they've got the cash grain long, and they've got futures short. It's penny for penny the same. They're going to make it on their cash or make it on their futures, as long as they're a hedger, not a speculator. And so our number one thing is to educate them on how that margin works. If you open a hedge account, we explain how my office clears trades through ADM Investor Services, how margin works. If you put a contracted December corn, one contract equals 5,000 bushels, just the basics of futures. One option contract is 5,000 bushels of corn, beans, wheat. It takes education to get these guys to understand, why do you have a margin call today? And why is that good on your farm? It's teach these guys it's not exciting if we sell 10% of your corn on your farm and corn goes down $1. Yeah, you're going to have a gain in your hedge account, but you just lost $1 on 90% of your corn. And if we sell 10% of your corn and it goes up $1, yeah, you're going to be stressed because you're going to be sending me money, but 90% of your operation just made $1. And to get that to a farmer level, we've created what we call Farm Plan, and it reports their position on their farm every day. We go update their yields and their acres, and it takes into account what positions they have on, and it takes into account their unsold inventory and gives them an average. If corn's up 15 today, they'll get a new report tomorrow that says, this is where your farm is today, and this is how much better it's positioned than yesterday, to make it as user-friendly and accessible to the farmers as it possibly can.
You've mentioned a term a couple of times here, a margin, having a margin account and margin calls and things like that. Whether it's the farmer perspective or the speculator or the grain buyer or whoever, what is the purpose of a margin account? Why is that required, Justin?
Really simple terms, it's like making sure that you're serious about it and you put money down to make sure that you're good on the contract financially. And actually, the weird thing is in the markets is speculators actually pay higher margin than hedgers. There's different margin rates for spec and hedge. So when you actually go open a hedge account and you're a farmer, we have a box we check if you're going to be specking or a hedge in this account, and the hedge guys don't have to put in as much money as a spec. They just do that to protect. You have to do it so if you have 2 contracts of corn on and corn goes up, that financially it's like having a balance sheet almost. It's financially settled every day in Chicago or wherever you're holding the position, and you have to make good on it every day. Same goes for the other way. It's a zero-sum game. If every position that's out there, there's someone else on the other side of it from you, and they have the exact opposite gain or loss you do. If you make 10 cents, $1,000 on a futures position, someone on the other side of that lost 10 cents, and you want to make sure that their money's in there to make your money good. Margin is there to protect everybody on both sides.
If you think about the purpose of the Chicago Board of Trade, and we covered this in previous programs, the purpose originally was to facilitate buying and selling, right? I have grain to sell. You need to buy grain. This is where we come to meet and do that. Yep. And the operation of the Chicago Board of Trade, even though such little percentage of what is traded is actually delivered on, you almost have to treat like every trade like that's going to happen, right? You
have to think especially if you're a hedger, you have to treat every position like you're serious and it's deliverable, because that in the end, like that's what it's going to be based on. You can always buy it back when you're selling cash or whatever, but there's all these guidelines and criteria of dates you need to be out of the position or you're going to get delivered on and you're going to own grain in a warehouse somewhere. That's like, I think people fear that. It doesn't happen much. It's we can control that. We can be out of the position. You just have to be aware of what you have on. But that's the whole purpose of the Board of Trade, is to match up people that want to buy and sell, and it's an efficient way to do it.
Let's go back to some of these other players that are in the markets, and you kind of hit on it because there's all types. They trade for all different reasons. Like the high frequency trader, the people who trade on weather headlines, or things like that. There's just a little bit of everything active in the futures market, isn't there?
Well, everything's active, and they don't have to have a reason. People can do whatever they want with their money. Like if people think, now they're going to get ahead of inflation and they're going to say, gosh, commodities, crude oil, gold, all this corn, everything's going to go up, and they want to put a basket of their net worth in commodities here. That's their choice what they do with their money. There's a lot of different reasons to buy and sell crude oil. There's a lot of different reasons to buy and sell corn. We just want to educate our producers on what's their reason. And if a grain producer's buying corn, it's a spec. Like, they got to figure out what they're doing with it, and we got to figure out if we're creating risk or managing risk. And it's all these players are in the market for different times and different reasons. And I always say it's like you can do whatever you want with your money. And there's some people out there, there's some funds out there with a lot of money that make anything anybody looks pale in comparison to what they can do. If they want to push around a market, they can. Short term. Long term, if crude oil goes up $30 because somebody's got a bunch of money and pushes it up, there's going to be a lot of people wanting to pump crude oil and push it back down and hedge it. It's just finding the right price. And I'm a believer the futures markets are forward-looking, and they've got everything factored in that they know today in the world, whether global war, inflation, anything out there you can think of, the price of corn today is the price of corn today. And not many people out there have an edge on if it's 1 cent off or $2 off. You can place your bets, but market's pretty good at taking in all the information and finding a happy medium for all buyers and sellers today.
A gentleman that he has since passed away, but he had a saying. He said, the market's knowledge is greater than the sum total of everyone in it.
Yeah.
That's pretty accurate, especially over long term, isn't it, Justin?
Yeah, the market's right. It is. And, but, Warren Buffett's got all these quotes. It's like you can stay in these markets a long time, but boy, if you're fighting it and you're speccing it and you're on the wrong side of it, it's going to eat you alive. And you see who's out in the ocean with their shorts off. If they don't have the money to cover their positions, the market can make people look idiotic once in a while, and it really flushes out people that have too much exposure, too much size. It humbles you. It's very humbling sometimes, but as a hedger, that's what we deal with every day with these farmers, is knowing their position size they should have on, knowing their crop size. I had a lot of clients get hail and wind and all sorts of damage this spring that probably the most damage my clientele's ever had. And obviously we adjust positions hugely according to that because of yields being down and hail and late planted stuff. We don't know what this harvest is going to look like, how it matures, and we've got a lot of exposure out there based on how Octave weather is. But we know what risk we have, and we know what positions we have on based on that size, and it's just our best guess today. But we're not buying and selling this market every day on a whim like some funds would.
Let's do some definitions. Let's talk about some of the terms that we've hit on during today's podcast. We've mentioned it a couple of times. If you had to define a hedger, how do you define hedger?
Hedger is somebody that has either a product or risk in a certain market. That cow-calf guy is a hedger. If he's buying, or a feeder, he's buying corn and he's selling fats, or he's buying corn and he's selling or buying feeders. It's somebody that has that risk, that they're protecting the actual risk that's inherent in their farm. When you sign up for a hedge account, you actually say, I have risk in these markets, these commodities. You say feeder cattle, live cattle, corn, beans, wheat, whatever. And we actually watch it then. If you start trading gold contracts in your account and a hedge account, like, you can't, it's not a hedge. You don't have exposure to the commodity. Therefore, you should open a separate account and have different margin rates. But it's somebody that has risk in that market or sub-market. Sometimes they have risk in wheat, so they'll spread their risk over Minneapolis, Kansas City, Chicago wheat, whatever. They're limiting exposure to what they need to buy or sell and taking a neutral position until they get that physical commodity bought or sold.
And you've mentioned it a couple of times, the speculator or speculative position. What is a spec?
Spec somebody that wants to invest money in the markets, whether it's short-term or long-term. They're not it can be Joe Schmo from the street. It can be a billion-dollar hedge fund in New York. It's people that want to speculate on, they don't have exposure to the markets. They don't have corn to sell. They don't have cattle to sell. They don't have ethanol to sell. They just think corn's going up. They think wheat's going up. They think whatever's going to happen. And they can invest accordingly in the markets. It's just, it's not a hedge. It's not a producer doing it. It's just anybody else in the world that wants to speculate. It's like buying a stock in the stock market. They can put their money wherever they want to put it.
What about, what's the definition of being long the market?
Well, long the market's a buyer, and I don't want to bore you to death with technical stuff from a commodity brokerage, but you can, buy and sell futures. You can buy and sell options, and long the market would mean you're a buyer. You own. If you're long corn, you're owning corn in your account. If you are long options, it depends if you're long a put or a call or short a put or a call, because a short put is a long position technically in the market. That's part of the education job. Is it's super confusing because you can, 3 ways to be long. You can buy a call, you can sell a put, or you can buy the board, or you can do multiple combinations of all of them. And you can get as detailed as you want, but actually it's pretty simple if you have somebody that understands it.
And then the opposite of that is being short the market. So what's the definition of short?
It's a seller. So you're short futures, you're long puts, or you're short calls. That's a short position.
Define volatility. When you talk about volatility in the futures market, what does that mean?
Volatility is just kind of a measurement of how much the futures markets are moving, or how much the guess is of how much the market's going to move by a certain time frame. And like I said earlier, 20 years ago when we started this, volatility was hardly noticeable. It was a couple cents a day. Volatility skyrocketed because of liquidity and because of economics in the world, I think, and demand. We have most days we have 10 to 20 cent moves in grain, just blindly back and forth throughout the day. You hardly notice it. That was an annual move 20 years ago.
Well, Justin, we've kind of got to the end of our podcast here, I think. But just as we kind of round out this discussion that we've had today, thoughts on sitting down, kind of educating yourself and surrounding yourself with the right people for your operation. Why is that so important these days?
Well, I think it's hugely important. I think I value unbiased people that have no conflict of interest, and they can come in and talk to you level-headedly about what they know. And one thing I'm really proud of what we've done at ARC Group is we kind of refer to ourselves as an investment bank of, for farmers. If you want to buy livestock revenue protection, if you want to buy crop insurance, if you want to margin your own account, if you want to not margin your account and write a hedge derive or a marginless position with us, I like that we can do it all in-house, independent of all end users. We don't have to go to all these 5 or 6 different people that are experts in all this stuff individually and have. If you're at a insurance broker's desk and all they do is livestock revenue protection, they're going to sell livestock revenue protection to you. And some days that's not the best product to buy if you're a hedger of feeder cattle or live cattle. If you have your choice of saying, gosh, I'm going to sell some futures and I'm going to buy a little bit of this livestock revenue protection because the government subsidizes XYZ, and a cattle on feed report came out at whatever time in the afternoon, and you can put on LRP if you're prepared and have your numbers ready that day. If corn's gonna open up 20 higher and feeders are gonna open $3 lower, you can put that position on, and we can do it in our office. And talking to one person that has all those choices of products and risk management tools all independently, that represents you, not an end user that's trying to get captive supply of your grain, I think is hugely important. I don't want an ethanol plant back home telling my family what to do with their grain. I'm going to offer it to him. I'm going to offer it to 6 other plants. I represent the farmer. And then what we try to do at ARC is take all that grain from all those farmers together and trade it in bigger packages into those end users and offer, instead of offering 10,000 bushel, 50,000 bushel here and there, we're trying to trade trains and bigger size with them to get better bids for our clients. And the only way you can do that is if you're hedged independently from all the end users. And if corn's down 50 cents one day and basis is the best trade of the year or that day, we don't care because we're hedged. We can go make a cash sale any day we want because all we're focused on is basis. We're just going to lift that hedge off and sell the cash, and you're still neutral on your farm. And you executed a plan, and you should be proud of yourself for minding your own business and having a plan and letting someone that knows what they're doing execute it. Communication's a huge deal. Have someone you can call and talk to. If you don't understand something, we want to be on the same page. We want you to understand your risk. We want to understand your crop insurance policies. If you get hailed out, if you get drought, we need to understand what you have. We'll communicate with your crop insurance guy if you have that, your banker. Communication and education is just huge.
We've been visiting with Justin Lovegrove for today's conversation about the players in the futures market. Justin is the owner, president, and grain marketing advisor with the ARC Group. Thanks for joining us on today's Grain IQ. I'm Chad Moyer.
Grain IQ is a production of the Nebraska Rural Radio Association with support from the Nebraska Soybean Board. It is brought to you in part by Nebraska soybean farmers and their checkoff. Grain IQ is hosted by Chad Moyer and produced by Rebel Saklocha. It is written and edited by Alex Wojcicki. Our project manager is Bryce Duskett. You can listen to Grain IQ on Spotify, Apple Podcasts, or online at ruralradionetwork.com.